So things you should do, make a team. It's much easier to go at it with someone in your foxhole than doing it alone. I'm very lucky. I've had a built-in partner since utero, being a twin. So that's been very easy for me. But we had a team right out of the gate. But make a team, get your branding, pick your markets. Don't look across the country. Just isolate it on certain markets because you want the depth of relationships with brokers, with investors.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Will is the co-founder of Matheson Capital. They are a multifamily real estate investment firm based in Charleston, South Carolina. Will, welcome to the show.
Thank you for having me. I really appreciate it.
Hey, man, the pleasure's mine. Listen, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
So to put it bluntly, we started with pretty much nothing, no investors, no real track record of ownership, anything like that. First deal we ever bought was actually a duplex in Los Angeles. Bought it with one partner we had from grad school. $800,000. 2 months later, sold it for $985, I believe. And since that time, that would have been January to March of 2018. I think we've done about 10 other acquisitions, 7 of which have already been sold, or 7 total have been sold. And now we're just continuing to grow, continuing to build. But yeah, we started with the smallest thing. Second smallest thing, I guess smallest thing would be single family. But we started with a duplex, and our last acquisition was 168 units, and we've partnered on some even bigger ones. So
that's a fast progression. I mean, that's only a little over 4, maybe 4.5 years. That's a fast progression, and shifting gears that quickly between, all right, duplex, now we're going to buy multifamily, now we're going to partner and take down bigger assets. How did you navigate that and do it without feeling like you're, just kind of, losing focus on whatever it was you were previously doing? I mean, that's a lot of different iterations of the business in a short period.
Well, I mean, I did skip over it and make it sound faster than it was. I mean, like we bought 2 units, and then it was a 6-unit deal and another 6-unit, and then 15 units, 24 units, 32 units, 32 units. 69 units as the lead sponsor in, I guess, March of 2021, that's where we were building up to. And then we were kind of a smaller partner on $25 million and $60 million deals. And we came back from that, really kind of grew a little name recognition doing that, broadened our investor base. And in April of this year, that's when we bought the 168 units. So it wasn't going from 2 units to 100 units in one deal. It was just bit by bit by bit, expanding.
I love that. That's really, really awesome. Tell me, investors, finding investors, investor relations. I mean, this deal takes 2 things, deals and capital. Let's talk about the investor experience side of things for you guys. You said you started off with no track record, no money, no real basis in the industry. How did you bring investors on and inspire confidence?
So we took a really very firm approach in terms of, no one's going to invest with us on a 10-year hold. When I bought my first property, I was 25. It was probably 2 weeks before I turned 26. When we did that, and I have a twin brother who's my partner in the business, like no one's going to invest with us for a 10-year hold. So what we're going to offer people are short-term holds, less than 2 years. I mean, our first deal was 2 months, but less than 2-year time periods, really high IRRs, aiming for 30+%. And we're going to show them, look, take a risk, take a chance on us working on this. We'll deliver you returns in a short amount of time. I'm not asking you to marry me. I'm just looking for a couple of years, not even. And by doing that, we were able to kind of grow through word of mouth, but really be able to show people, hey, look, we're young. I didn't work at Graystar, I didn't work at Blackstone, but we have a proven result. And to this date, our average LP return has been 38%. So
that's fantastic. But how do you project that out of the gate? Again, without having a deep bench of experience saying, hey, look, I've done this multiple times. How do you project saying, hey, we're going to give these outsized returns to investors?
I mean, I'd say it's probably the same way everybody else starts, which is just you go the friends and family route, which is risky in some ways. But, at first you really have to walk people through the business plan. This is why I think the rents are under market. This is the type of renovations we can do. And as you broaden out, that's in some senses, it's the riskiest money because you don't want to disappoint your friends and family, but it's
right.
I mean, in a lot of ways, it's the easiest because shock of all shocks, no pension fund is going to give a first timer that type of money. So, you start with friends and family and you ask them, hey, who are 5 people you can introduce me to? Hey, look, I delivered for you last time. Who else can I talk to? Things like that.
Yeah. And it's funny. I was on a call last week and that was one of the things that was brought up, which is how actively are you mining the current investor database that you guys have? What is one thing maybe you guys are doing to make sure that you constantly stay in front of investors and get those investor referrals?
I mean, when it comes to getting investor referrals, there's no substitute for, FaceTime and, well, except for possibly results. So the fact that we've delivered for so many of our investors and we have a really high retention rate, that helps in terms of, hey, look, I've performed before. Can you do this? But, you can't be on the phone with all of your investors all the time. I mean, this sounds simple, but, you post on LinkedIn, you have a newsletter just monthly to your investor group. Maybe, quarterly, you give a little more details, but just monthly, it's always a great chance to say, hey, look, our most recent acquisition, we're surpassing our pro forma rents to the people who are in it. They feel great. For the people who didn't invest, it's a little, hey, you missed out on this one. Hope you get the next one.
Yeah, certainly. And that's it's those constant points of contact that it's the hardest ones to get out. I know it took me a long time to finally get around to putting out I do a weekly newsletter, but still it's like once you're in the habit of it, it's a lot easier. But getting that up and rolling is it's a discipline in its own right.
Well, yeah. And I mean, to a certain extent, you also want to have something going on. There's nothing worse than writing a newsletter when you have nothing going on. I mean, we didn't launch our website until we had been in business for about 3 years, because to put it mildly, I didn't want to advertise the fact that we barely owned anything. It wasn't until we bought maybe our 7th property that we put a website up, because I didn't want to advertise to the world, all I own is a 32 unit property here. I wanted to appear like we had a lot more going on.
Yeah. Hey, man, that sounds really smart to me. Tell me, I mean, being in the multifamily space, I know we talked about this a little bit before we kicked this off. You feel like you're not reinventing the wheel. Like, hey, it's just a business that a lot of people are involved in, and we're just one of the other players in it. And I feel like maybe there was some discounting of your own skill set in that conversation, where it's like you guys are doing things and things maybe that everybody else doesn't know and see. So tell me this, what's one way that you guys are finding opportunity right now? Like, and not necessarily asking for your industry trade secrets, but like, what is it you guys are doing in order to make the multifamily business work right now?
So we've built, I feel like this is a terrible answer. In some markets, specifically Charlotte, I think we have some management efficiencies. We have a partner in Charlotte that we work with who does a phenomenal job with owner management and let's just call it automation. So that can provide a lot of savings on that front, juice cash flow beyond what would normally work. We've built some really strong lending relationships, particularly with banks, which banks aren't as subject to fluctuations on the 10-year treasury as, say, Fannie Mae, Freddie Mac, debt funds, such and such. So that's provided us a bit of a financing edge. And I think it's, I used to work for Marcus and Millichap. I always say this bluntly. I know how to talk to brokers. I'm a tremendous suck up. I speak their language. So I think we've been able to build some really good relationships. So in that sense, we have some management efficiencies in some markets. My brother, Evan, he actually he was the answer key in a grad school at Columbia for real estate finance. So we've got some really tremendous modeling really tremendous analysis, some great relationships on the broker side and the lender side. And obviously we always try to perform for our equity. So from top to bottom, those are some things we do that we believe gives us an advantage. But again, we're not trying to reinvent the wheel too much. We're just trying to find efficiencies here and there.
Hey, and it's those minor course corrections. I think that, or maybe it's not a course, maybe it's the wrong word, but it's the minor efficiencies that you put in that can really make all the difference in the world. Or you can take a subpar deal and turn it into a good deal, or a good deal and turn it into a great deal. I mean, those are the small nuances that make all the difference, I think, in the world. What is, when you look at the multifamily industry as a whole, are there risks that you see in the marketplace? And if so, how are you guys avoiding those?
So, I mean, the risks we see in the marketplace, that is one of the nicer things about multifamily. Cushman & Wakefield just put out their first monthly newsletter. I can't recall the exact name. And it detailed 4 macroeconomic scenarios, and multifamily as an asset class performed the best across industry types in all of them. We have a housing shortage, so people still have to live somewhere. It's not 2008 where they were building houses just everywhere and people are buying them up, and that's why you see the trouble there. We have a housing shortage, so we're pretty economically insulated. If there are risks, interest rate risk is a big one. We typically are proponents of fixed rate debt with no prepayments. So that gives us protection on the upside, or protection against rising interest rates, but flexibility on downward interest rates if, as projected, interest rates do get cut. We are moving away from the B and C space just because those are the Class A renters, the least rent burdened at this point. I know COVID was a big time for real estate, but in a lot of senses, just multifamily, it was very tough to collect rents. So that's just, that's a few things where we're seeing in the market. I do think there's some collection risk. I do think there's some interest rate risk, and we try to mitigate that by just a little adjustment in our strategy.
So you guys are moving out of the B and C space, and it sounds like you're looking to acquire just Class A assets. Is that right?
Largely, yes. There's still some good opportunities in the B and C space. We bought a deal for $73 a door in North Carolina earlier this year. We were very happy with that. But you're in the industry. A lot of times you'll see, hey, look, here's this 1970s built property that's had 3 value add initiatives in the last 10 years. And magically, here's a 4th value add. I think a lot of that's being overplayed, especially if you're dealing with inflation. You'd like to own hard assets, but you want your tenants to be non-rent burdened. And that's the case in the Class A space. They're the least rent burdened tenants. They're lifestyle tenants. That's part of the reason we're making that transition.
When you say, for our listeners, when you say the word non-rent burdened, is that a percentage of income spent on rent as a whole? Like, so say it's 25% of total income or disposable income. What do you mean by that?
Just rent as a percentage of income. Typically your Class A renters are more educated, more affluent, more flexibility. So, when you're making $5,000, or let's just say $8,000 a month, $100,000 a year, $3,000 in rent is not a significant issue for you, versus if you're making $50,000 a year and someone increases your rent $500, that's a pretty significant swing. I live here in Charleston, South Carolina. The amount of people I know who had their rent hiked 20% in some of the nicer buildings didn't bat an eye. Just like, okay, renewing. I don't want to move. I don't want to move into Somerville or wherever. I want to stay downtown. Yeah, location, quality of the asset. Really, your renters are very easy to absorb rent increases.
Right. Yeah. And where that ends, who knows? But it's certainly, how far those rents can be pushed in that Class A is hard to say. But certainly, like you said, rent as a percentage of income, we certainly want to be in the lower end of that if possible.
Well, there was a recent Wall Street Journal article, I think this past weekend, that just talked about we are, since 2020, back then you had rent and mortgages roughly on par, but now rent has gone up 10% the average monthly mortgage payment is up 50%. So buying a house is more unaffordable. So, I'm not saying you're going to see 20% rent increases, for the next 5 years, but if inflation persists, then those tenants are going to be the ones who are managing it most easily.
Right. One of the things you'd mentioned early on in the show was that, you didn't want to project a 10-year hold. Has your guys' strategy changed from a shorter term hold to a longer than maybe what other people in the industry are projecting their hold time are for apartment communities?
So we typically still don't model beyond 5 years. When I said earlier, we're not going to do a 10-year hold, that was when we were starting out, had no track record, anything like that. We wanted to deliver short terms. As we've proven, if we've given proof of concept, as we've delivered more stronger results, we think that longer term holds are definitely a possibility, but we still don't try to model at 10 years. We typically are now modeling 3 to 5 years.
Gotcha. One of the things, other things we talked about here pre-show was the Masters in Real Estate Development, a course that you said you took at Columbia University. And you've gone back, I think you mentioned also, as now a speaker there. Is that right?
A couple times, yeah. The Masters in Real Estate Development degree, Columbia University, MS Red. I actually have a book over my shoulder for that. But yeah, it's a really great program. A lot of really successful alumni. I would say New York City is the real estate capital of the world. So it's a great place to learn. But yeah, my brother and I have gone back, given a lecture there a couple times just as a guest lecture. Great place if you're looking to hire real estate people. I'd look them up. You need your new analyst, you need your new associate. Give them a call. Man,
there's a golden nugget that we haven't had on this show like that in a while. So there you go. If you're looking to hire, which is my next question, because I think you said your talk there was on how to start a company. Is that right?
Yes, that was the gist of the.
What are things that you're telling the people in that master's class? What are you telling them? Like, is there like top 3 things you'd say, hey man, if you're looking to start a company, and or I'm going to add my own caveat to this or my own addition to it, which is, grow your company. What are you telling people to do?
So we've got a few things, a list of 5 things that you should do, and then a list of 5 things you should not do. So things you should do: make a team. It's much easier to go at it with someone in your foxhole than doing it alone. I'm very lucky. I've had a built-in partner since utero, being a twin. So that's been very easy for me, but we had a team right out of the gate. But make a team, get your branding, pick your markets. Don't look across the country. Just isolate it on certain markets, because you want the depth of relationships with brokers, with investors. Network. And the 5th step in that is just start small. You're not going to get a 10 million. I mean, if you can get a $10 million equity check on your first deal, more power to you. But if you didn't work at BlackRock, I'd be really impressed if you did. If you do, call me. We'll talk. I need some tips.
Right.
But, start small, build your track record that way. The things we tell people not to do, specifically, don't over allocate your capital so you can only do one deal. You're not in the business to do one deal. You're in the business to do a lot of deals. So don't sink everything you have into one asset. Don't commit to too long of a time frame. Again, when you're just starting out, you might outgrow your property. If you buy a $2 million property in your first year, hopefully by year 3, you don't want to spend your time on a $2 million property. Get in, get out. Don't be inflexible. We like no prepayment penalties. If you get a yield maintenance deal, you might be stuck in it. You want to maintain your flexibility. Don't be passive in terms of the asset. Especially when you're starting out, you tend to defer to property managers, things like that. But it's your asset. No one cares more than you do. So you got to be really active overseeing that stuff. And then do not do ground up development. That was another big one. It takes a long time. It's very complicated. It's very risky. And the big thing is when you start, you do not want to take an L. You don't want a loss on the scoreboard.
No, you don't. That's a great, a really, really good list. And I wish we had the time to break down the unique components or each individual component there in your list, but obviously we don't. But I think that's, even just from a cursory overview, that's a really cool 5 do's, 5 don'ts. And I think it's also funny that one of yours is your last one is don't do ground up development, and you're in a real estate development course telling them that.
Well, I mean, look, when you're working for somebody else who's got, all the time and the money, and you're on salary, and, they've got a lot of experience. Yeah, that's ground up development. Like, go for it. But when you're starting out yourself,
right,
you need big equity checks. You need long time frames. I mean, another reason to start short is on small short-term deals, you get acquisition fees, you get promotes, you're getting paid twice. Ground up development, you could be 3-4 years out from getting a real payday. So you want to avoid that.
Yeah, absolutely. And I think your point there was when you're starting out, avoid ground up development. So that's really, really cool. Will, this has been great. Thank you for taking the time to come on the show today and really tell us how you guys got started, the things that you guys are doing to find opportunity, and then also how you are, just carving out your own niche in the multifamily space. I think one of the things you mentioned there early on was just small efficiencies in a lot of different departments that are really driving returns for you and for your investors. So you've given us a lot of things to think about, all the way down to, if we're looking for new hires, where to go farming for new people on the team. So certainly
Columbia Masters in Real Estate Development. Great place. They're all good. Even the architects.
That's awesome. Will, thank you again for coming on the show today. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
I mean, LinkedIn, I'm pretty easy to find. Will Matheson, Matheson Capital, but our website, mathcap.com, really clever abbreviation. I know, mathcap.com, mathcap.com.
Mathcap.com. We'll make sure we put that there in the show notes. Will, thank you again for your time today. I do appreciate it.
Thank you, Sam.